Good morning, everyone. My name is Will Grant. I'm a wealth manager here at 360 Financial. I am a CFP and CPWA, which stands for Certified Private Wealth Advisor and Certified Financial Planner. So quick background about myself. I've been in the industry for 7 years, and throughout that time, I've worked with over 500 families as their dedicated financial planner, ranging from young professionals to specialization with retirees and business owners. So today I will be co-hosting and as a moderator with Mike today on our webinar titled, Could You Be Earning More Than 5% on Your Cash? We have a Q&A time dedicated at the end, but please feel free to enter in your questions throughout the presentation so that we can address them using the chat feature. Before we get into the material, I will turn it over to Mike to give an introduction.
Hi there, everybody. Thanks, Will, for that. Thanks you for the introduction. Thanks for co-hosting this with me today. It's going to be a great event. We've got a lot of good education materials. We're going to cover a number of different areas, and I'll talk about that in a second. Most of you on this call are already clients of ours, and thank you for spending some time out of your valuable day to be here with us to learn more about kind of what we're talking about our investment committee meetings and what we're talking about with our clients. And that's this 5% number. 5% is the new zero, is what I say frequently to clients. And, when Will says, can you talk a little bit about the firm? A lot of you know this already, but, I started up the firm in 1995. And believe it or not, it's coming up on 30 years. And we've grown from just me being the firm to about 25 people. We have a couple of CPAs and an enrolled agent over in our Edina location. We have a place up in Elk River, which Brian manages that for us, and we have a whole team here in Wayzata. So it's been fun as we've grown to help more and more families, which now we're up to about 600 different families between our different locations that we're helping. Could be as high as 700 now. And that's really the joy. That's what we get out of what we do here, is to enrich our clients' lives. When I set the firm up in 95, I was hoping that we could enrich some lives. I didn't know for sure. And thankfully, there was a marketplace for solid advice based on fundamental pillars of wealth management on a fee basis instead of a commission basis, and acting as a fiduciary, in the best interest of our clients. And I'm glad to be here today to share this with you. So the first thing I'm going to do is jump into a share screen, and we'll go through a little bit of an agenda as far as what we plan on covering today. And the first thing that we're going to cover is our agenda. And basically in today's agenda, there's 5 different topics that we want to cover. Current cash and interest rates. How did we get to the point that we're looking at 5% as an alternative? And have we ever been to this point before? And how does this cash fit into your investment or your portfolio allocation? Where can we get this 5% on our investment returns? What are some alternatives that potentially could get us even higher returns? And then we'll summarize it a little bit, especially for the new people on the webinar that want to hear more about the life wealth planning process that we have here at 360 Financial, and a little bit about our investment strategy. Okay, so that's the flow of today's presentation. And let's jump into it so that we can move along into the very first screen is, how did we get here? So this chart is basically just showing over time, going back about 24 years to 1999. It's showing what interest rates have been doing. And when we're tracking rates here, what we're tracking is the federal fund rates. Okay, and a lot of times people have no idea what the federal fund rate is. And all it is the Federal Reserve sets an interest rate for banks to charge other banks for overnight loaning. And so it's a way for them to control, them being the Federal Reserve, shorter term interest rates. And frequently shorter term interest rates will affect midterm rates and long-term rates. Okay. So look at what we have here. And you can see here as my, red delta illustrates, back in 2000, when we had a market that was very hot, stock market was hot, we had dot-com bubble going on, that bubble burst, the economy went into a recession, and interest rates dropped drastically. So it went from about 6.5% down to about 1% on these overnight rates. And then things started climbing back up, and rates got back up to this 5% number. And then we had the Great Recession, where rates started dropping drastically again. They stayed low for a number of years. They started climbing back in 15 up to about 19. Then we had COVID hit, and they went back down to zero. Now we've seen this escalation of interest rates, especially last year, where they've gone basically from almost a zero level, 0.25%, up to about 5.25%. And these usually are in ranges. And the range right now is between 5.25 and 5.5. So we kind of picked this 5.38% number. Okay. And it's really tied into these forecasts that the Federal Reserve is making. And so if you look at GDP growth, they're looking for lower growth rates in the economy. So GDP, gross domestic product, is kind of showing how our economy is doing. High numbers, robust growth. Negative numbers, negative growth, which I know doesn't make a whole lot of sense, but that's recessionary. Okay, and then we have unemployment rates in this 4% range. And then the Federal Reserve is looking for unemployment to increase over the next couple of years, and the economy to not grow much quicker than it is currently. Okay. Headline inflation, what they're hoping for is to get to this 2% number. Right now we're sitting at 3%, and core inflation is around 4%. So we're working towards what the forecast is from the Federal Reserve to basically, if we have lower inflation in the future, we have higher unemployment in the future, these rates should be going downward in the future.
Mm-hmm. And Mike, so the Fed met yesterday and Tuesday. Could you give us kind of a summary of their latest decision with interest rates and maybe their outlook for the year end?
Yeah, great question, Will. So what happened? This is real timely, because what happened yesterday is Chairman Powell came out and he said, you know what? This 1% range doesn't seem to be kind of where we're going. We're expecting that the economy is going to do a little bit better next year. It's going to be 1.5%. Now, you and me and everybody watching the webinar, you might be, okay, what's the big deal? 1 to 1.5. But what it's telling us a little bit is that the Federal Reserve is thinking that this interest rate hiking that they have been doing isn't as effective as slowing down the economy as they had hoped. And again, it's counterintuitive. They want to slow down the economy, maybe even send us into a recession. And that is all in the effort to combat that high inflation that we were experiencing, about a year ago at this time. So they yesterday said, you know what, GDP might be more like 1.5% for next year instead of 1 or 1.1%. And we might have to increase interest rates a little bit more, make sure that we're on top of this economy that's doing a little bit better than what we had expected. And basically the bottom line is to try to control these inflation numbers as much as possible. So again, counterintuitive. Higher unemployment seems like a bad thing. The Federal Reserve is saying that's a good thing. Slower growth or higher growth rates seems like a good thing. The Federal Reserve is saying that's a bad thing. And that's a reason those two things lead to more inflation. So that answer the question, Will?
Yep. Thank you.
Okay, good. So let's look at kind of what's been going on in the interest rate market, and specifically, how does it impact a few different areas like deposit rates? How does this impact and what's positive for retirement savings? So what we have here on the left-hand side is two different graphs. Okay, and the one on the top up here shows how interest rates have drastically shifted over the last year. So just going down, 3-month T-bills are at 5.4%. That's about where we're at today. This is an August data point, but it's pretty much the same. And that blue line represents the yields on these treasury bills. Okay, so treasury bills are short-term government bonds, and they call them bills instead of bonds. Notes would be mid-term, and bonds are long-term. So these are short-term instruments. Okay, they would mature in 3 months. You could buy 6 months. You could buy 12 months. They're all considered T-bills. Okay. Government money market account paying about the same amount of interest because they're just buying short-term T-bills. And there might be a little bit of a management fee in here of some sort. Okay. Bank CD rates, 6-month CDs are running on average nationwide about 2.2%. Again, look at where they were a year ago, 0. Your Your bank savings accounts and your bank interest accounts are still basically paying very little in interest. Now, some banks have had to bump up their interest rates to keep deposits, and that kind of goes down to this slide down below. You'll see that bank deposits hit a high mark in January of 22. Okay, a lot of this money was COVID funds that came into people that had more money come in than they normally would expect, and therefore they stuck it into the bank. Okay, small banks had the same phenomenon going on, but now what we've seen, probably for two different reasons, is rates, bank deposits have been coming down in both the large banks and in the small banks. By the way, this little blip in here is when Silicon Valley and First Republic went out of business back in March. Created a lot of disruption and a big drop in those deposits because people were taking money out of those banks and maybe going up here and buying things like treasury bills or moving some money to larger banks because they thought that was more safe, more conservative of a move. Okay, so the positive about these higher rates that we have here is that we can earn more money on our cash, and hopefully the banks pay a little bit more money, and they are a little bit more money on your deposits. Okay. For retirees, when we were only getting 1 or 2% or maybe 3 on our on our bond part of our portfolio, and now we can get more interest from our fixed income or bond part of the portfolio. That should be a little bit more stable for our retirees. And then I've already talked about the bank deposits as far as kind of how they've been coming down. One, because consumers are spending those reserves that they had, and two, because they're probably moving a lot of those deposits to other areas. So a lot of data points in here, but again, just starting to set the picture for, what's kind of going on in the marketplace right now. What's the negative effects on higher interest rates? Well, borrowing cost, right? Especially when it comes to mortgages. And the higher the mortgage rate, the less you can afford as far as the housing that you're looking at purchasing. The monthly payments go up. We're also seeing higher borrowing cost for cars, credit cards, installment loans of any sort, now carrying higher rates. Margin rates on on brokerage accounts have gone up. So that cost, that negative effect of those higher costs really creates an issue for affordability. And if you look at this middle chart here, all it's showing us is mortgage rates over the last 5 years. These are 30 years and 15-year mortgages, but look at the sweep upward. So the 2 and 3% mortgages that we were experiencing back here, obviously are gone. And now we're sitting around 7% on a mortgage, maybe 7.5%.
Mm-hmm. So Mike, we had a question come in regarding the slower economic growth due to higher borrowing costs in terms of businesses. Would you be able to provide an example of why, as a business, it is more cost effective to have higher borrowing costs, maybe from comparing 2021 to now 2023 with higher rates?
Yeah, so let's look at the mortgage rates as a proxy for borrowing costs for a business. May or may not be accurate depending on the credit quality of the company and everything else. But when we're down here and we're looking at 2 and 3% interest rates for a company to make business decisions when the cost of money is 2 or 3%, changes drastically versus the cost of money being 7 or 8% or maybe 9%. And it really just comes down to the math of cost of money. If borrowing is 3 times more expensive from an interest cost perspective, it's going to probably pull back a lot of business decisions. And that's kind of what the government is hoping for, right? They're kind of hoping that businesses don't go build new factories. They don't expand into new markets. They don't create more efficiencies by merging with other businesses, because the cost of doing so is so high that the numbers don't work. And so instead, what they do is they retrench from that business activity that normally would create jobs and create more robust economic growth. And they pull back and they wait until it makes more sense for them to do so.
Perfect. Thank you.
Yep. So let's look at inflation a little bit, because that's what really got us to this point, as I've talked about already in a couple of times. So let's go back to 50 years, 1970s, And so driving around your Ford Pinto, you're paying the, buck in gas, things are going okay, but we had a recession come on. And when the recession came on, what you ended up with was these different, headline inflation numbers being a problem. And so we see interest rates and inflation going up and ebbing and flowing going back all the way to the 70s. So let's look at kind of over here. And I want to look at this line here, which is our average inflation over long time periods. Okay, so here's our 50-year average. It's 3.9%. Our headline inflation right now is 3.3%. So the government calculates inflation in a few different areas: core inflation, CPI, with food and energy, and they mark them all separately. Okay, so let's just focus on headline for a minute. And headline includes food and energy in it, where core does not, just so you know what the difference are. So if we look at this, back here, remember, and I have a lot of clients that tell me, hey, my first mortgage was 14%. 7's no big deal. It is a big deal to the newer generation of home buying when they're used to, 2 or 3% mortgages, but relatively, yes, they're still low compared to what we saw in the 80s. Okay? And every time when we've had higher interest rates to slow down the economy, it has led mostly to recessions. Okay. And so that's that negative growth that I was talking about. But the one thing I think you'll find interesting about this is look how tame inflation has been for decades. And we're pretty much just sitting in this range. During the Great Recession, we had deflation, because of the crash in real estate prices. And that led to a crash in stock prices, but it also created deflation for a very short amount of time. And then we had this big bump up last year of inflation that was really caused by a few different areas. It was caused by this economic policy that the Federal Reserve flooded the economy with a bunch of money because of COVID. And we all know the story about that. That also created a surge in demand, for a lot of goods, specifically goods. So timber prices went way up, window prices went up, energy prices actually crashed during COVID, if you remember correctly, because of the shutdown. People weren't driving, but other goods went up quite a bit in prices because now people were at home and they were looking around their homes and they were saying, what, I don't really know if I really like the way this place is set up. So let's tear down a couple of walls, let's repaint, let's put in some new appliances, let's buy some carpet. And that's what created this supply chain issue that we saw a lot of a year ago. And that's what caused inflation. Now we're seeing that temper back down and inflation is coming down. And the Federal Reserve is trying to get it back down below this average number and back into that 2% range.
So Mike, what you just mentioned there, we had a question come in from an attendee asking why would the government want companies to not grow or create new markets? I think that kind of resonates what you just were talking about. Could you just clarify for them why the government is kind of doing what they're doing from the Fed standpoint?
Yeah, they want companies, again, it's counterintuitive. They're trying to hold back growth, and here's why. And what they're trying to do is get this inflation number back down. Because if the cost of goods and services escalate at a very fast rate, then your purchasing power is decreasing at that same rate. That's bad for the consumer. It's also bad for governments to have this high inflationary period. And so it all comes down to is their number one fight right now is to make sure that we have inflation that's closer to 2% and not 9%. And so far, it's actually working. Okay. So, here's another way of looking at interest rates and inflation. Let's compare the two of them. And so what this chart is showing us here is a comparison between nominal yields and real yields. And so what are we showing? 10-year treasuries. Okay, so these are 10-year bonds, not the 3 and the 6 months that I was talking about earlier. Current rate on a 10-year bond is about 4.27%. Okay. Core inflation is about 4.7%. So we actually have a negative return between the yield of a 10-year bond and inflation. And so it's a negative 0.44%. So that's what we call your real return. And so it's real important that if we're looking at this, that we're focusing on that 5% area for cash and cash management needs so that at least we can keep ahead of core inflation. So it's interesting when you look back at time, then we start looking at these, real yields. There's lots of times where we have negative real yields, even though treasuries were higher. So why would that be? Well, of course, that would be because inflation was higher than the treasury rates. And that's kind of what we're at right now. So big question is, that we have is, are you making the right decisions about cash and how you should be invested in these different areas? Okay. And we always say the first thing we need to do, and it's no surprise to our clients, but the people who are new to the webinar, the first thing we want to do is always look at what are your form goals: family, occupation, recreation, and your money goals. And your investment strategy is going to align with what matters to you. What's the most important thing for you to accomplish? And then we break that down into 3 different tranches, if you will. Short-term goals, that would be your cash equivalents. That's where we're talking a lot right now. Having your 6 months worth of expenses sitting in the bank account. Well, maybe instead of at the bank account earning 0.5%, you move it to treasuries that earn you 5+%. Okay, now there's pros and cons to both. So you need to talk to your wealth advisor about, what makes sense for you. But these short-term goals are really where we have some opportunities right now. Okay. And the reason we don't want to put all of your money into longer term investments with short-term goals is because of this chart down here where it shows volatility. Stocks can go down 39% in 1 year. They can be up 40% in 1 year. For a short-term goal, that volatility is probably too much. But you'll notice for a longer-term goal, the volatility starts to evaporate, starts to minimize. It never goes away. There's always volatility. So it's real important that we look at short-term goals versus your mid-term goals versus your long-term goals, and make sure that we're focused on your family, occupation, and recreation goals. Make sure that we have your savings account and your emergency funds well stocked, earning you a good interest rate. And then we can start looking at these longer-term goals.
And one of the foundations that we often start with is that emergency fund that you touched on, Mike. So the range here just references 3 to 6 months. Could you maybe give an example of when maybe a 3-month might be more appropriate than a 6-month, maybe with someone who's single, has a stable job, or in a longer emergency fund if you have a family or an unstable position? Any examples you could provide there?
Yeah, there's a lot of them, isn't there? I mean, from the perspective, let's look at your job security, your paycheck, and if you're married, you and your spouse's paycheck, kind of where that money is coming from, and so if we're going to have the potential losing one of those paychecks, we might want to, prepare for it by having more money in those shorter term instruments that we could use for expenses that would pop up, like your mortgage payments, like your utility bills, so that you can get through, if that would occur, you can get through that time period, without scrambling by selling your longer term investments. On the happier side, if you got a big expense, it says here like a wedding coming up. I've got a couple of weddings in my family. 2 of my kids are engaged. If that money is going to be needed in the next year, that's a good place to keep some extra cash. You wouldn't want to go buy an individual stock most of the time, with that wedding money. My son and my daughter might not be very happy because of that volatility in that stock, and their budget would be cut. So does that help answer the question?
Yes, Will? That's perfect. Thank you, Mike.
Okay. All right. So let's look a little bit at kind of, why cash isn't our solution kind of over longer time periods. Cash is great right now. Again, we'll talk a little bit about where we can get some better yields, and we're in a pretty good spot from a cash perspective. But let's go back 40 years, back to 1984. I was a freshman at Marquette University. Interest rates were very high back then. Okay, actually I was a sophomore. So interest rates on CDs, as I'm showing over here on this chart, are about 10%. And they peaked out at about 12 on 6-month CD rates, and then peak CD rates. Like, wow, 10% was a pretty good rate of return. Maybe I should just put all my money in a CD and kind of forget about kind of the investment principles that stocks generally perform better than bonds, and bonds perform generally better than cash or CDs over longer time periods. But this is just a shorter time period, and it shows a subsequent 12-month rate of return after CDs peaked out. So in 84, when CDs peaked out in June, highest rate you could get. 1 year later, when we look at kind of what other investments were doing, bonds were coming down in price. Bonds were paying more because the yields were higher, and then the bond prices started moving upward. Okay. U.S. high yield corporate bonds had a better rate of return, and stocks had a better rate of return than CDs. Okay. And generally speaking, you can go back to these time periods when we had rate hikes over the last 40 years, and they stopped because then the CD rate stopped going up. What happened to other asset categories 12 months later? Okay. And so again, you kind of see stocks outperforming cash and bonds outperforming cash. Again, there's no guarantee that this is going to happen in the future. We're just looking at historical data points. Back in 94, we see a huge advantage to the S&P 500 or 500 US based companies versus the peak of CD rates. And here we don't. And this was that dot-com bubble that I referred to. Back in 07, we kind of see the same sort of picture. And then in 19, when we had some interest rate hikes, it's a little more muted, but the correlations are the same. So the reason we bring this up is we do like these higher interest rates. We're taking advantage of them. We're talking to our clients about them, and you should be talking to your wealth advisor if you're not a client of ours, or give us a call about what are the alternatives. But this big shift to, well, I'll just get rid of all my stocks and I'll just buy T-bills proves, at least historically, to not be the smartest investment strategy. That's more of a savings strategy. Savings is short-term. Investments tend to be mid or long-term. And then over time, this chart just goes back literally, for decades, and going back to 1928, so coming up on 100 years, and this shows that over time, stocks do perform better than cash. And again, maybe what this is actually showing is that cash underperforms substantially over stocks. But everybody needs cash. And we're just saying in a well-diversified portfolio based on your form goals, don't jump everything to cash because of about 5% rates. Okay. And here's why. Inflation. This is our silent killer. We've talked to clients for years about inflation, and it almost became kind of a conversation that most people just skimmed right over. And now, because we had 9% inflation a year ago, it's come back up. So think about, not only is this the silent killer of a financial plan, but it's one of the worst things that can occur to a retiree on a fixed income when prices are going up at 9 or 10% rates. And so other types of investments tend to generate better returns than inflation, which is our number one enemy, especially in retirement. So this chart is just showing the green line is inflation over time. Okay, we talked about that already. The purple line is T-bills, which in this example is actually a little bit lower than inflation. Currently, T-bills are higher than inflation. Okay, so there's an opportunity there for us. Bonds generally perform better than inflation. We get our best growth out of our best gauge against inflation out of large cap stocks. And then small caps have the most volatility and they perform even better. But you have to be willing to have part of your portfolio subject to a lot more volatility. And that's why it's a long-term type of investment. So again, what this is showing is that out of major asset classes, generally speaking, stocks and bonds do beat inflation over longer time periods, but not every single time period. And, then our goal, go back here for 1 second, is make sure that at 360, we're maximizing, these cash holdings that we can get the best return for you on, but really, again, just building that diversified portfolio to try to keep ahead of our enemy of inflation. It's one point I wanted to mention before I jump to this slide. This is an interesting slide, a lot of data points on here, but basically what it's saying is that the personal savings rates, were very, very high back in the 70s. And then they declined drastically until we got to 2005. So we literally had, 40 years of personal savings rates declining. Okay. And then we started seeing an increase in savings rates. Part of that is because we came out of the Great Recession. People were worried about their jobs. They started saving more. Then we have this huge spike up, and that's that COVID money that we were talking about that came into the system and created a lot of our inflation. And now we can see that savings rates have kind of lumbered back down to a low that area that we saw back in, roughly 2005. So almost 20 years ago. Okay. Household excess savings has also declined, and we're starting to see consumer credit, which had been declining for years, especially during COVID, starting to pick back up. Now, it's only about the same level as pre-COVID time period, but it's starting to pick out of this really low area. So all this is showing you that the consumer actually is using a lot more of their savings. Okay. That will eventually cause a slowdown in the recession as well. The consumer is what's been driving the economic growth. Consumers still out there spending a lot, but their savings are starting to drop. What's interesting about that, and I hope it's because of the good planning that we've been doing for years with our clients, is our clients are seeing the opposite effect. They're seeing a lot of their cash accounts building up. And again, sitting at the bank, not earning very much money. So what do you need that money for? And they're like, I don't know. It's just kind of been accumulating because our strategy that we have laid out, hopefully, is why, and it's creating more income that I'm actually spending. So what should I do with this cash? And that's what sparked actually this whole webinar, is this phenomenon that our clients are in a different spot than what we're seeing here nationally for these data points. And then we have, a couple of different examples here as far as what you might want to be looking at on how you can get rates. And again, talk to your financial advisor, call us here. Everybody on this webinar has a financial advisor at 360, and some of you are not with us. So if you call on in, then we can talk a little bit about some of these opportunities for you. But you could look as simple as a government money market account over here. These are usually T-bill accounts, very conservative. Again, there's some pros and cons. You need to know kind of what you're putting your money into, and that's why it's important to talk to an advisor. But you can get this north of 5% number on a lot of these accounts right now. Okay, so these are different than your insured bank accounts, and so they're not insured. These are T-bills that are backed by the U.S. government, but they don't have FDIC insurance on it. So they're different. They're different animals. But that's one area. Okay, the other thing you could do is look at buying treasuries directly. So skip the fund, just buy the treasuries. And that's what we're talking about over here. And we can get about 5.5% in treasuries right now. They popped up a little bit yesterday with the Federal Reserve saying we might actually increase rates a little bit more towards the end of the year because the economy is doing a little bit better than what we expected. Now remember, 1.5% growth is not much growth, but that's what they said yesterday. Okay, so we'll get about 5.5%. By the way, we can buy treasuries that actually mature in a month, 2 months, 5 months, 6 months. They're traded. They're probably the most liquid investment in the world. They trade every single day. So we can buy increments, any time period that makes sense, not just 3, 6, or 12 months. Okay. And then the after-tax returns, over here, what we're talking about is are there some opportunities to save some money on taxes? And specifically T-bills do have a tax benefit versus CDs, as an example. T-bills, on the interest that we earn from these T-bills, we do not pay the great state of Minnesota, if you're a Minnesota resident, state income tax on that interest. Okay. You could also look at tax-free municipal bonds as a possibility to earn some interest that's exempt from both state and federal taxes. But that's, again, a conversation that you should have on the pros and the cons with your financial advisor.
Mm-hmm. Mike, we had a question come in referencing the 6-month T-bill that their goal would be to maintain the funds during that 6-month period, but just wanted to know about the liquidity and maybe some clarity on if I need the funds before that 6 months.
Yeah. So what we normally tell people when we're buying a 6-month T-bill is we're going to keep it for 6 months. I mean, just because we know exactly what the yield to maturity is, we know what we're going to make on that money, but so we plan around that. But if a situation changes and you're like, well, I need that money, I did lose my job, or I need more in my expense account because I don't know, the roof needs to be repaired and I wasn't accounting for that, we can always sell the T-bill. So they're very, very liquid assets. We can always sell them. You might not get your 5.5% because the price will go up and down a little bit through that 6-month window until maturity, but we can always sell them.
Thank you.
Yeah. Good question. So when we're looking at interest rates, here's our yield curve right now. Here's, when we look at this blue line, this is our current yield curve. And what does that mean? Shorter term T-bills here, longer term bonds as we move out to the right on this horizontal axis. Okay. So what you see is an inverted curve. You see that short-term rates are paying more interest than the longer term rates. And we've talked about that a little bit. The inverted yield curve frequently leads to a recession. Doesn't every single time, but it does. But more importantly, when we look at the yield averages over the past 10 years, you'll see that we're on the very high end of the averages all the way across the board. This gray line represents where we were just about 18, 19 months ago, so yields at about zero, yields at about 5% now on these short-term instruments. On the 10-year, yields at 1.5%, yields at 4.2% on the 10-year bonds. So let's see if we can take advantage of these yields while they're still here. Other alternative investments besides T-bills and governments. We could look at corporate bonds. And again, there's pros and cons to all of these. You can look at short-term corporates, mid-duration corporates, or long-term corporates. You can look at high-quality corporates or low-quality corporates. So it's a really important discussion to have with a financial advisor. But we can get higher yields out of the corporate bond market than we can get from the government bond market in many, many cases. Muni bonds. I mean, again, for Minnesota, we know that taxes are not going down. That we have billions of dollars of surplus, but taxes haven't dropped. Social Security tax is still here in Minnesota. Muni bonds are nice because they give us both state, if we're buying Minnesota bonds, they give us both state and federal tax-free yields. So you won't get 5% on a muni bond normally, but if you get 3 or 4%, maybe in your tax bracket, that's the equivalent of getting 6 or 7%, depending on how much you pay in taxes. So muni bonds right now are a little bit scarce because of the $1 trillion in government spending that's on infrastructure. Municipalities are issuing less bonds. But again, another conversation with your financial advisor, but might be a good alternative, especially if you're in a high income tax bracket. Dividend paying stocks. A scenario again where you can get dividends from a company. Maybe you buy stocks or a basket of stocks where the companies pay dividends. They have a history of paying dividends. They increase their dividends over time, help you keep ahead of inflation. Maybe you get a little bit of growth out of the price of those stocks, within that basket. We really think that, dividend paying stocks makes a lot of sense even before all of this inflation, because it's a nice way to create wealth and or a rising income stream potentially on that side as well. So a few different areas to talk to your advisor about. And again, these different areas are giving us an opportunity maybe to take advantage of something we haven't seen for a decade. And this is the fixed income valuation chart. So as I pointed out right now, if we look at yields on treasuries, and we're sitting at this blue diamond, about 4.5%. Okay. Historically, the 10-year median is 1.6. And we've got this range, and we're at the top of the range right now of almost zero all the way up to where we're at today. Okay. So see. And then we see in municipal bonds, we see the same sort of thing. It's a larger range, but our blue diamond is right up near the top of the range. So in every of these bond categories, the yield to worst, a lot of times kind of like the yield to maturity. If you buy a bond today and you hold it, then you get the yield and maybe a little bit of growth because it's selling at a discount. We've got some really good potential returns coming out of the U.S. bond market. And we could also look at, what's going on internationally. Yields, again, are higher than they have been in a decade. And coming back into the U.S., these are high yield bonds in the U.S. and leveraged loan bonds or bank loan funds here in the U.S. Actually a little cautious on these right now. Talk to your advisor to why, but they definitely have some nice yields associated to them. So I know a lot of data points in here, and what's important to understand is when interest rates go up like they did last year, especially, your bond prices drop. And that's why most of your bond funds were down last year in price. It's a teeter-totter. If you think about it logically, it just makes sense. If rates are higher today than they were 2 years ago, that bond that's paying 1% interest, this isn't as valuable as the bond that pays 5% interest today. So the price drops to make it equivalent to the current interest rate market. And so as rates, if we get to a scenario where rates start to go down again, remember that chart that we were talking about earlier, if rates start to drop again, then you have a scenario where you actually do have an opportunity maybe to make a little bit more total return on these bond funds. But again, talk to your advisor about how that may or may not help you on your planning. I know I'm running a little bit long because I'm getting into some of the details, but I'll try to wrap it up here and just talk about, again, if we look at portfolios and we kind of create an investment strategy that's customized based on form goals, there's still a place for stocks, there's still a place for bonds, and there's a place for cash. And this chart, this really goes back to 1950 through 2022, so a bear market, and just talks and looks at the differences between stock returns and bond returns. And then real simple, if you just had half your money in bonds, half your money in stocks, what would those returns have been? And of course, over longer time periods, this volatility, the ups and downs of a portfolio or an index starts to get muted because we're long-term investors instead of short-term holders of companies or stocks. And that's the one thing to just keep in mind when you're in these portfolios, you're buying, especially on the stock side, companies. You're not just following a stock market, and these companies will make changes to their business plans. They'll make changes to their marketplace, and a lot of them will continue to thrive in good years and bad years. Not all of them. And that's kind of what this chart is illustrating. So cash is one piece of the pie. When we look at wealth management as a group of what it is, there's pillars of wealth management, and cash is definitely a part of that pillar. And we need to make sure that we have, our cash holdings in the right spot. And then we have debt management, tax planning, huge right now from the perspective of let's keep what we have. Investment planning, if you have kids or grandkids, education planning is so important for our business owner clients. A lot of business planning, retirement planning, legacy planning, and finally on top there is your risk, your insurance, and what do you need to make sure that we have those areas covered. Okay. We have an investment strategy that's built around, these longer term perspectives, and a lot of you are utilizing it. It's based on two fundamental beliefs. We need to have foundations and investments, and that's your fixed income and your stocks in there. And then we have areas of the marketplace that we know are leadership areas that we want to try to take advantage of. At least we think are leadership areas, and we have that in the portfolio as well. So in conclusion on the program, and thank you for sticking around here, it's three things that are action items to take away from today's program. Evaluate your cash strategies and how much you're holding in cash now, and do you need everything that you have? So right now is consider your goals. Sorry, I'm getting a little bit of, here we go. Consider your goals. Make sure that we have the right amount of money in cash, and we're taking advantage of these higher instruments on a short-term basis. Okay. It's also a good time to talk to your advisor about, your blend of stocks and bonds. Are you comfortable with kind of the risk, the volatility that you have in your portfolios? And should you make any changes in there, especially if your needs have changed or your goals around form, family, occupation, and recreation have changed? And then let's target 5% interest on money that you just don't need sitting at the bank and to draw a check against. So those are the main takeaways from today's program. How did we get here? What can we take advantage of? And maybe look a little bit beyond, what's going on in short-term instruments and how it impacts your long-term and your medium-term goals.
Thank you, Mike, and thank you everyone for your time today. So we will share a recorded webinar that we've just went through today. Let us know if you're interested in a follow-up conversation. Everyone's situation is unique and requires personal discussion. So we are your sounding board, so please ask questions. Please feel free to put in some Q&A that we're going to enter in now, some questions through the chat feature for additional information on 360 Financial and as well with our life wealth process. We are going to walk through what that looks like for people who maybe this is their first time hearing of 360, or for current clients who maybe have someone who would be interested in a conversation with us, what that process looks like. So we would get you signed up for a complimentary fit meeting where we could just ask a lot of questions, understand if we could be a good fit for what you're looking for. So continue to kind of put in those questions. We will start to go through what that life wealth process looks like in the meantime, and I will queue Mike up for those questions as they appear.
Okay. Thanks, Will. So what I'll do is I'll cover our process a little bit. Again, most of you on the call know us, know how we work. This might be beneficial to your friends and your family members who might need some help during this kind of turbulent time. For people that haven't worked with us, welcome. I think we'll spend a few minutes and just talk a little bit about how we do things and why we do what we do. First of all, there's some disclosures that we also always have to show, that investments go up and down, CDs are insured, government bonds and municipal bonds are not, so we don't want to minimize that discussion. But again, it's a good discussion to have with your financial advisor. So let me just kind of give you an overview of what we're doing here at 360 Financial and have been doing for years now. And we've built what's called the life wealth plan. So it's the best of your life goals and your wealth goals, and we put them together. And we know that when we're working on your life wealth goals, there's certain pockets here on this Venn diagram that we want to focus on. And the number one thing we want to always focus on is what matters to you. What are we solving for? What are your problems? What are the things that are keeping you up at night? How can we help focus on what matters to you? And then on the other side of this Venn diagram is, what can we control? And we know there's lots of things we can't control. The Federal Reserve is going to do what they're going to do. We don't have any hotline into Chairman Powell to tell them to stop or to start doing something. So what we have to be able to do is how do we act? How do we plan around that goal? Okay. We can't control the stock market. We can't control taxes, but we sure can control our planning around all those aspects. So that's really the driver to the process around how we work with our clients in this life wealth environment. And we base it on 4 attributes for each client of what matters to them. And it's all built, I've alluded to it already, around FORM. And FORM is our acronym for your family goals, your occupation goals, and your recreation goals. Okay. And we know at the end of the day, these are the whys. These are the things that give you purpose. Okay. And you'll notice money is the last aspect of the acronym with the M. But it's also, in our opinion, not the most important thing. The why are we doing what we're doing is more important than the how or the conduits to get to those goals. Money is great because it gives us options. It gives us opportunities. It allows us to do certain things, send our kids to college and retire and travel. But very few of our clients ever say to me, Mike, I want to make as much money as I possibly can. Actually, I hear the opposite. Mike, I can't take it with me. What good can I do with this money while I'm still alive? And while we're looking at those lifetime goals, what we're trying to address for all of our clients are these impactful financial events. And as Will said, every client is different. And we have about 700 clients. They're all unique. And we have customized strategies for each of those unique situations. But we also see a lot of commonality around these FORM goals. And these are these impactful financial events that we have to plan for, like estate planning and your legacy planning, your investment strategies, both in bull markets and bear markets, high interest rate markets and low interest rate markets, your family security, which really kind of gets into that risk management, that insurance piece. And Brian up in our Elk River is a specialist in this insurance area and brings so much value to that discussion. Okay. Retirement planning obviously is huge, but those conversations also often lead to second home conversations. How will I fund one? When should I take and when do I have to take money out of my retirement accounts? And when should I start taking Social Security benefits? And what's the most tax advantage way to start funding this retirement strategy? And that leads right into the tax planning. And for our business owners, a lot of times they have a unique set of issues that they need to address, whether it's buying and selling the business or maximizing their wealth while they own that business, so that everything is tied into that business. And so there's a lot going on during these impactful financial events that we address in the life wealth process, which we've narrowed down to 4 steps. The very first step for the new people here and the people that have been with us for a while is schedule a call with us, 15 minutes. Let's see if we're on the same page as far as our process and your needs, and if there's a fit. And if there's a good fit, and we schedule a meeting to go more into detail about what's important to you, what matters to you, and we agree it makes a lot of sense to move forward because that conversation leads in that direction, then we go into the what we call get organized phase. Let's start pulling all those statements from your old 401k plans, your IRAs at different firms, your deferred comp from your employer. Let's start pulling all that together so that we can come up with a strategy, and we can implement a strategy that's built on, again, your goals. So we implement a strategy, we set it in motion, and every single plan is reviewed and aligned on a regular basis. And that review and that alignment looks like this. We break it down into quarterly installments. And we do a lot of work up front with our new clients to get this set up. But we specialize on tax planning and investment management early on in the process. We start looking at debt and cash flow and insurance and risk management in the second quarter of the process. We do a deep dive into retirement planning in the third quarter of this process, and then really head deep into estate planning and legacy planning on the fourth quarter. Now, does it always work in this cadence? No. Again, everything is customized. Maybe for you, the most important aspect is estate planning. So we shift that up to quarter one, and we solve those issues before we move on to these other issues. The neat thing about this all-inclusive approach is we have it built into our system that our clients come in for meetings once or twice a year, or maybe we do them on Zoom now. And then we also have what we call quarterly conversations that readdress, to this point earlier, that readdress this review and alignment of your plan to your goals and have those goals changed. One thing that's really, really important is taxes. We're headed into the fourth quarter. It's hard to believe. Taxes are really important. The more you can keep, the better. And you don't need to pay any more in income tax than what the government's entitled to get, or capital gains tax. So with that in mind, we've got a strategic acquisition that we made at the end of last year with the Repakian Company. So an Edina-based CPA firm with 2 CPAs, an enrolled agent, and a couple of support people to help you integrate tax preparation and compliance into the tax strategy of your wealth management plan. So it's really powerful, and I welcome you. A lot of you that have stuck around probably don't even know about this, because we wanted to get through busy season and wanted to get ready for this announcement as we head into fourth quarter, when the best tax planning needs to get done. Because remember, if we do tax planning in January or February, after the calendar year is done, it's too late most of the times. There's a few things we can do, but most of the planning has to be done coming up. So something with these 2 specialists joining forces and us acquiring part of the firm and having this subsidiary type of partnership, I think it really positions us well to make sure that we're focusing on a lot of these goals, while Repakian Company can focus on your tax strategies as well. So pretty comprehensive program, is to say the least. And it's driven by a team of people that are all smiling here, that are here as our mantra is to enrich our clients' lives. And it's by leading them through those impactful financial events that I was talking about earlier. We have dedicated certified financial planners and financial advisors. We have dedicated service people to help you with your needs. We have dedicated support people in other areas that have a specialization, so that this whole team of people are working collaboratively with their specialty in mind to get you to where you need to go. It's pretty impactful, it's pretty powerful, and it's worked with 700 families. And if you're not a client of ours now, give us a call and see if it might work for you. With that, that's a brief overview of our process in about 8 minutes.
Well, thank you for your time today. Thank you, Mike. Thank you, Will, for walking us through our cash options. We will be emailing out the webinar post-event. And I wanted to mention a couple upcoming webinars. In October, we will touch on year-end tax planning and discussion around qualified charitable donations. In November, we will be conducting a webinar on Minnesota residency before you head south. And Joe Rapacki will be attending those webinars with us and fielding any questions. So we will have our partner CPA on the line to help field those questions. So this concludes the program. If you're interested in speaking with Mike, Will, or a 360 Wealth Manager, we'll be reaching out with a scheduling link along with the webinar. You can go online too to set up a brief introductory conversation. Any additional information on 360 and our proven life wealth process, we'd love to share with you. So thank you again for your time. And if you have any further questions, we are here to have a conversation, to be your sounding board and learn how we can help you now. So thank you, everyone.
Thank you, everybody.
Thank you very much for attending. One thing I'll just throw in real quick, because now we have 3 locations. We have the Edina CPA practice, we have the Elk River location, and we have the Wayzata office. You know, if there's a location that's more convenient for you to meet to discuss some of the things that we talked about today, just let us know which one it is, and we'll make that work for you. But again, just trying to provide more value to you as a client and or potential new client by giving you some options there too. Well, thank you.